Well, we're on the doorstep of a financial collapse. This is fairly obvious for anybody who's paying attention. So, something that's going to come back into the news soon, which was prominent in the news in the 2008 financial collapse, is derivatives. And derivatives are something that are wholly not very understood. And so, I'm going to go into a little bit of derivatives explanation as best as I can. It's a bit of a complex subject, but to start out, the first thing you need to understand is the amount of derivatives that are outstanding in the world. And what is a derivative? Well, derivative, let's go down to the base of the word. The word derivative comes from the word derive. So they get their source and their value is derived from some other type of financial instrument. So they're kind of like a piggybacking bet on, I mean, as absurd as it sounds, two financial institutions could get together and they could take a bet on whether it's going to rain on Friday and put down $1 million, and that would be a derivative. It's derived from the outcome of the weather on Friday, so that would be a derivative. That's a bit absurd, but it's not really that absurd relative to what derivatives actually are when you get into it. So hopefully by the end of this explanation, you'll realize how crazy derivatives are in terms of their potential danger. I mean, what did Warren Buffett call them? Weapons of mass financial destruction or something like that. And I mean, there's $2 quadrillion of outstanding derivatives. Now, apologists for that will say, yeah, but it's only 10% notional. Okay, so it's 200 billion, notional value. Still a lot of money. So $2 trillion in outstanding derivatives that are also unregulated, folks. This is the thing that is really mind-blowing for me about derivatives, is that they're unregulated. So I'm going to tell a little story. I'm going to divert here and go off into a little story. And that sort of illustrates this. Years ago, I was in an MLM company, probably about 35 years ago. And we were interviewing this guy to become a member, and he was a computer coder, fairly high-level guy. And we asked him what he did and what he'd been doing. He said, I'm kind of in between gigs right now. I was working for one of the big banks in Canada here. I won't say the name. Not really important, but because they're all basically doing the same thing now. And so he was telling us that he just got released from a non-disclosure agreement, an NDA, for 5 years, where he had to keep his mouth shut about what he'd been doing. And what he'd been doing was coding a private trading platform for a major bank. A private trading platform. Now, we thought the guy was crazy. We're looking at each other going, okay, private trading? Like, is there such a thing? I thought, securities had to be regulated by the government, right? So, of course, we just thought the guy was making stuff up. But it occurred to me years later, when derivatives became a subject matter in the public sphere, right around 08, 07, I flashed back to the story this guy told me and went, oh, wow. He was telling us he was designing the derivatives trading platform for this major bank in Canada. So, holy mackerel, this is real. I actually met a guy that was involved in this at a very primary level. So, as I said, that's a bit of an aside story, but I just found it interesting that kind of popped up on my radar when derivatives became a subject matter. So let's kind of talk about how the mechanics of derivatives work. Now, this is going to be very rudimentary. There's going to be guys out there that understand it better that'll dive in the comments and maybe add something to this, but this is generally correct in what we're doing. There might be some functional errors in my understanding of it, but it kind of goes like this. So first, before you can really understand derivatives, in a sense, you kind of have to understand banking and leverage. So banks operate on reserves in the U.S. They don't in Canada and other Western nations. And it's mostly commercial banking that uses reserves in the U.S. The reserve concept is no longer practiced in Canada, Belgium, Australia. A bunch of Western countries now practice zero reserves now. We can talk about that more. I have an older video, I'll link it in the description, that actually proves from a a working paper on the Bank of Canada website that we don't practice fractional reserve banking, just so you know. I'll put the link in the description down here. Check that out. It's an older video I did years ago. So basically, the banks will hold a certain amount of capital and then can loan out multiples of that, the commercial banks, right? I think the reserve ratio is about 3% now in the US. So they're basically operating on kind of 30 to 1 or 33 to 1 ratio. So this is problematic when they get into extreme growth in the economy and building booms and housing booms, because they get out to their limit of leverage, and the only thing they can do then is lobby the government to get the leverage ratios higher, which they probably do and have done over the years, but that's a far longer term way to get to the goal line of being able to lend out more capital. So what they've come up with is in this derivatives, because they got rid of the Glass-Steagall Act, and it allows all these various different types of institutions like insurance companies, commercial banking, and non-commercial banking to collude together, which is what Glass-Steagall and what we have in Canada as the 5 pillars tried to prevent. Because as soon as these different institutions get together, the first thing the geniuses in the back room start doing is figuring out ways to create more and more creative financial instruments to leverage more money, among other things. That's one of the things they do. And so this was one of the greatest schemes, in my opinion, ever for leverage, is this derivatives idea. So let's go back to '08 and look at the collateralized mortgage obligations, right? So what is a collateralized mortgage obligation? So let's break down the wording. Collateralized, meaning it's turned into having some sort of monetary value. Because let's face it, mortgages are debts, right? Now, how do you make a debt into an investment? Okay, well, so we package up a bunch of these mortgages and put them in a bundle, say a couple of $1 billion worth of various different mortgages. And these would be all like AAA rated, Moody's and Fitch rated at AAA. So these are darn near as good as sovereign debt. This is going to get paid in their opinion. So it's a very safe bet that these mortgages will get paid, they will go to final term, and the debts will get settled. So now that they're all packaged up together in a bundle, what we do is we get an underwriter, an insurance company, or another large financial institution to collateralize that or insure that debt. So you got a couple $1 billion, so they write up an insurance policy or some sort of agreement that says that we'll cover that. We'll put up the $2 billion so that debt is now, if something goes wrong, the $2 billion kitty is there, we can take it, and the debt is settled. So that there's no longer really technically a debt. So what that does is it frees up the balance sheet of those financial institutions to begin lending more and more and more in capital. But here's the problem with all this. Every time, look at the economy as a treadmill, and on that treadmill you got all this economic activity. Let's just take housing, because that's what we're talking about here. So you have this treadmill of economic activity that has, probably evenly spaced. Obviously, economic activity isn't absolutely evenly spaced, but excuse me. If we take an average, there'd be economic activity on this treadmill. Anytime you want to go beyond the standard current economic activity, like let's say their typical housing sales in the GTA are 100,000 units a year. If you want to increase that to 200,000, which is not normal, you have to reach in and pull future production forward on the treadmill. Well, as you do that, as you go in and you pull forward future production up to the current date, you leave a hole. How do you fill that hole? Well, you don't. What we're about to fill that hole with is a major depression, in my opinion, is what's coming. That's how the hole gets filled. There's just no economic activity there. And in Canada particularly, I know we're talking about the US, but we live in Canada. Canada in particular, the housing is such a large part of our economy that when we have one of those holes in there, it's not just housing that suffers, it's everything, because the house is, as George Carlin stated, it's a place to put your stuff, right? And all the other stuff that's part of our economic active world goes inside of a house. So all of this is conspiring to create a huge downturn right now. And derivatives are going to be one of the first things that's probably going to pop. I heard a stat, I'm not sure, it was around a year ago, a guy was evaluating a couple of these commercial mortgage obligations where they've packaged up not residential but commercial buildings, and in this case it was malls, these big malls that are like here in Oshawa where we are, few hundred yards from Oshawa Centre, a mall like that. So they packaged in this one derivative. There was 38 malls, and 37 of them were financially distressed. So that's a foregone conclusion that that's going to go bad. So even if you have one or two of those institutions inside of one of these packages go sour, it can sort of contaminate the whole bundle. And due to the contractual relationship of a mortgage obligation like that, a derivative, there's no way to separate out the bad investments or whatever's in that package because of the nature of the contractual obligation around it. It simply has to stay in place. In fact, I did a little talk for some friends of mine that were trying to understand this back in '08, and people were getting foreclosed on in their houses. And I said, well, what the people should really do is they should stay put. Because technically, legally, if you understand what you're dealing with, if your mortgage has been put into one of these derivatives, they can't separate your mortgage out individually and pull it out of there. That's illegal. So also, if they don't have the original document, they have no claim. So unless they can get access to the original document, there's a higher claim on that document. So the derivative owns the house essentially. And so there's no way to extract one of those out. And so in reality, nobody can make a proper legal claim against you, in my opinion. Not financial advice or legal advice, folks, but in my opinion, if someone doesn't have the original document, I mean, you can verify that for yourself. Original documents mean a lot. Copies don't mean much of anything in law, because if somebody has the original, they have a higher claim. So anyway, that's kind of an aside note for people that are looking at this, but derivatives are going to come back into the fray here again. And unfortunately, these are going to probably be the fuse that blows up the system. These unregulated, like, it's hard to believe, but they're really unregulated by the securities commissions in various different countries. These financial institutions are trusted to make these private bets and these private relationships with each other, and to do the right thing by it, I guess. I don't know what the logic is for not regulating these, but, and here's another big thing. There's an analogy that I heard a guy say one time I thought was really appropriate, and of the mess that derivatives have created in these various different entanglements with other financial institutions. And I use that kind of analogy for entanglements because of the analogy I'm about to use. I was talking to a fellow the other day about it, and I said, try to imagine it like a big bowl of spaghetti, of wet spaghetti, just cooked spaghetti. Each strand in there is a financial institution, and obviously that strand is going to be touching a lot of other strands of spaghetti in that bowl. And imagine each one of those connections as it touches other strands in the bowl being a financial obligation, a contract, or a trade with another financial institution. And this is how messed up and involved all the financial institutions are with each other. So the problem with that is, in my opinion, is that it's like a domino effect. So for example, Evergrande was in the news back about 4, 5, 6 months ago, and they were on the verge of some really big problems. This huge construction company in China that's been building all these huge building projects. And they're in deep. So Moody's and Fitch, the rating agencies that rate them as AAA sovereign debt or AA or whatever they do, stepped in and looked at the situation and basically gave them a reprieve for 6 months, is what was the last thing that I heard, that we'll revisit in this 6 months. So translation, we're never going to revisit this ever again. And basically, that is, in my opinion, that's the, you might as well call that an announcement that they've collapsed. Because if we can't evaluate them right now, the question is why? Why? Because we're going to come to the conclusion that they've collapsed, and we're just not ready to be the bearer of bad news. You know, I don't want to be the first guy to announce the collapse because it's going to be on my shoulders or our institution's shoulders. Probably something like that, right? Nobody wants to be the first guy to say, hey, you know, game on, right, when it's something this dire, because the numbers are bigger than they've ever been. I think the numbers of derivatives now are almost double what they were in '08. So going to be a big bomb go off here soon. So anyway, derivatives are a little complicated, a little hard to understand, but it's really back just to review the simple mechanics of it. Is you have a huge bundle of investment or bundle of capital or bundle of debt that you ball together, and then somebody insures that debt. So now that debt is technically paid in case, the mortgages within that or whatever financial instruments are not paid. And so that just allows them to leverage out more capital into the loaning sphere, and really just exacerbating and adding fuel to the same fire, ironically. But this is the flaw of our financial system. It needs to keep growing. It needs to keep doing this in order to survive. So anyway, it's probably any day now we're going to start to hear some news about something in the derivative field that's blown up in our faces, and we'll have to face the music. So anyway, that's a basic explanation of derivatives, folks. Hope that helps going forward. Thanks for listening.